Please start. Yeah.
Hello and a warm welcome to all our viewers to another session of Take Charge of Your Money. Today we discuss a topic that is a source of misery to many of us, namely tax planning. However, it need not be so. Once we get to know the basics of tax planning, it will go a long way towards making our portfolio more tax efficient. And to tell us more about the options which are available to us that we have in order to make our tax more efficient, tax planning more efficient, we have with us Ms. Vaishali Kale, a practicing chartered accountant and a tax expert. She is the proprietor of her firm Vaishali and Associates, and her practice includes international taxation, transfer pricing, and forensic accounting. Welcome, Vaishali. We are so happy that you could join us today.
Thank you, Meera. Thank you so much. I'm happy to be here. Thank you.
Thank you. When we talk of tax planning, we have to consider both the short-term and long-term tax planning and the individual implication as well as on the family, the overall portfolio. Most of us focus on taxes only as an annual exercise when we are filing our tax return. But we should actually have a more mindful approach towards tax planning, and hence we have this discussion today. And if any of you have any queries, you may please ask your queries in the comment section and we will revert to you on the same. You may also email to us on wikilifeandcareer@gmail.com and we will be only too happy to revert to you. One topic of recent interest is the old and new tax regimes. Vaishali, could you please throw some light on this and how one can decide on which regime to opt for?
Okay, so Meera, just to give a basic introduction, the government actually, has the intention of trying to make the whole taxation regime a little hassle-free, and less complicated. So they, in 2020, in fact, they introduced a new regime where you could file your taxes and you were not eligible for any deductions. However, what happened was till last year, the regimes were such, the tax slabs were such that most of them couldn't, or it was not efficient for most of them to opt for the new regime. However, in the 2023 budget that was presented in February, our honorable finance minister has brought in a couple of changes where I think the paradigm shift has been that it was clear that the default regime would be the new regime. So unless a taxpayer chooses to have an old regime, he or she would always be, his taxes would be calculated based on the new regime. So that was one big major move that happened, which will be applicable for the current financial year, which is 23-24. Now, the differences between the two obviously have been that in the old taxations, old regime, you have a lot of deductions which are applicable, which tax, all of us basically are eligible to claim those deductions and thereby reduce our taxable income. However, in the new regime, there are no deductions which are available. But like I said, since the government is encouraging people to get into the new regime, in the current budget which was presented and which is applicable for 23-24, there was one deduction which was extended to the new regime, which is for income, whoever has income from salaries, there's a standard deduction of 50,000. So that has been extended even to the new regime. So in a nutshell, if you say, basically, what can actually decide whether one should choose an old regime or a new regime is the amount of deductions that you have, which you have been doing, because old regime has been there for a long time. So most people have gotten habitual to certain payments that they make, whether it's investments or expenses, and for which the deductions could be claimed. So if you ask me a straight question as to what one should choose, ideally, I can just give you in a nutshell that if you have deductions which are less than 1.5 lakhs annually, then it's always tax efficient to go to the new regime. If you have deductions which are more than 3.75 lakhs, then the old regime is more tax efficient. Now, if you have deductions between 1.5 lakhs and 3.75 lakhs, then it depends on what your income level is. So if you have any deductions in between, I would always ideally say that, you actually see how much is your deduction, calculate taxes in both the regimes and decide which one is more efficient. So, but like as a thumb rule, like I said, if you have, and most of the salaried people do have deductions which are more than 3 lakhs or 3.5 lakhs, 99.9% they would be more tax efficient if they choose the old regime. But like I said earlier, and I stressed, from the current financial year, one need to choose the old regime because the default regime is going to be the new regime. So that's something that one should definitely keep in mind. So, yeah.
Thank you. That was very useful and quite an eye-opener actually. We didn't realize that there was so much to study in the old and new regime. Again, coming to this tax deductions that you were talking about, like you said, most people must be familiar with the tax deductions because they have been doing it, mechanically for so many years.
That's
But
right.
are people actually, using all the options which are available to them, or are there something which are not so well known? Can you please touch a little bit on this?
Okay, so I think the most popular have been the ATC deductions, which include, your life insurance premium. It includes ELSS, so equity-linked saving schemes, or the senior citizen saving schemes, all those. What most people miss out on, and which is very surprising because this also has been for last at least, I think 8-10 years it has been, where NPS was basically introduced, which is the National Pension Scheme. So apart from the 1.5 lakhs, which is the threshold for the ATC deduction, and of course, I'm talking here, I mean, let me actually make it very clear, this is only and only if you choose the old regime. Okay, so new regime, this is not concerned at all. But if you choose an old regime, then 1.5 lakhs is the threshold limit for ATC, which includes your health your life insurance premiums, your provident fund contributions, your a lot of education expenses on kids. All those come in the this thing. But what most people miss out on is there is an additional 50,000 deduction which can be claimed if you invest in the NPS, which is the National Pension Scheme. So that is something that maybe people would want to add to, that is because that I see even in quite a few of my clients. I had to actually tell them that why don't you open an NPS? And they have, in fact, as an investment also, they have been giving decent returns. So it's not that you're going to lose out on that. So that's one thing which one could actually look out if they have, already invested in NPS. The other thing quite a few people miss out, and which is a common thing, is the ATD deduction, which is for your medical insurance premium. Now, most of you know that medical insurance premium for self or your spouse or dependent kids, you get a deduction up to 25,000. Okay. What most people miss out on is if you have a deduction, which is your premium is less than 25,000, then you also have a possibility where you can claim medical expenses up to 5,000. So medical expenses could be anything which is like, preventive health checkups. So, you have the routine medical checkups that you do for which you pay, or if there are any medicines that you've been taking on a regular basis. So that, those 5,000 can get added but of course, the within the threshold limit of 25,000. And this is only for people who are not senior citizens or whose parents are not senior citizens. Now, if you have a dependent parent who's a senior citizen, or if you yourself are a senior citizen, then this threshold limit extends to 50,000. So typically for a family which which has senior citizen parents and a person who is not a senior citizen who is filing a return, and if the parents are dependent on this person, then you could have the 25,000 of your own, which is your medical premium, plus you can have 50,000 if you have spent any money on expenses for your parents who are senior citizens. Now, these could be regular expenses. Quite a few, unfortunately, most of the senior citizens, unfortunately, have either BP or diabetes, which is very common. It's unfortunate, but yeah, most of them are on regular medication. So those medical bills can be attached. Of course, but these are not, these expenses can be allowed as deduction only on an actual basis. So if you not spent, then you cannot, it's not like a deeming provision. So if you spend, you definitely get that. So that is something that one could see if they are, utilizing those. The other thing is also for rental payments, so a lot of people know that you get an HRA deduction. Okay, HRA deduction can only be availed on if your salary component has an HRA component. Okay, but if you don't have an HRA component and if you're still staying and paying rent and you don't have any property in the place where you're staying, then you have a deduction which up to 5,000 per month, so 60,000 annually you can get. Of course, there are limits to it, but yeah, ballpark, you can say about 60,000 you can get. Now, this deduction is also available for people who have income which are not from salary. So it's, if they're professionals or if they have income from business. And so obviously for them, HRA is not a component in any case because they don't get any salary. But if they're staying and they're paying a rent, then they could get this deduction. Even if you're staying in your parents' place, then you can actually have an agreement registered, a rent agreement registered with your parents and claim that deduction. Of course, in this case, the parents or whoever is shown as a recipient has to show it as his or her income. So now, obviously, if it's a third party, you're not concerned. But if it's your parents, then, that's something that you would want to make sure that they file their returns and they claim rental income in their returns. So that's something that you have to do. Apart from that, of course, you have your donations, you have interest on educational loans, which, people quite a few times are not aware. So which, you get those deductions and you need to be mindful about them. Yeah.
Thanks. What about ESOP? Nowadays, a lot of people are getting ESOP as part of the salary. Now, ESOP could be in Indian shares or in foreign shares. So how does that impact?
So ESOPs has, in fact, that's one of the pain points with most of the people, and there have been a lot of representations to the government also, where in this budget one had thought it would get addressed, but it didn't get addressed. So this situation in ESOPs are, you actually get taxed at 2 points. Okay, so there is one, the first point of taxation is where you actually exercise a right, okay, and you get allotted shares. Now, on that date, the difference between the fair market value of that share and the share and the price that you paid for the share, okay, that is taxed as perquisite and is a part of the salary component. Okay, so that's the first instance where you get taxed. The second, of course, is when you actually go ahead and sell those sell those shares, where you will get taxed as capital gains. Okay, so there are always two this thing. Now, like you rightly said, when you have these shares which are you are in a company which is listed, obviously market value is easily available. So, one can actually see how it goes and fluctuations and all those. But there are instances where there are startups where ESOPs is given as one of the major component to retain talent. And of course, there are people who actually work in MNCs where, ESOPs of the parent company, which is not situated in India, those are given. So typically there is always a, it's people get mixed up as to how do we determine. So it's been very clear that wherever there are ESOPs for an unlisted company, then a valuation has to be done by a merchant banker, okay, category 1 merchant banker to know what is the value of the share on the day you exercise, right? So now the flip side here is like, quite a few times you don't have, I mean, you do the valuation, you exercise the option, and like I said, you are taxed on that first day when you exercise the option as perquisite. So actually, it's the nominal income that you get. You don't get anything in your hands. You get shares, right? But tax has to be paid upfront. So there's a cash outflow, but there's no cash inflow. So that's a very, very tricky kind of a situation, and that is where actually one needs to keep a eye as to when you would exercise it, because tax needs to be paid immediately. And you may not, because it's not a listed company, you may not be able to dispose of the shares to actually, get fund flow for paying taxes. Now, government, there have been a lot of representations that have been sent to the government. The government only made a slight change to startups, okay, and that was in the last budget, where they had allowed some deferment of taxes. There are conditions that they have actually given, but that's only for startups. For everyone else, I think it's just that you need to keep an eye. If it's a listed company, the most ideal thing would be exercise the option when the share prices are at the lowest, because then your perquisite value would be less and you would be taxed less. But yes, I mean, that's something which one needs to actually keep in mind and review on a regular basis, because you might just miss a bus and you will end up paying more taxes.
Yeah, true. That's true.
Yeah.
What about other sources of income like business or income from business or profession, property tax, property income, and capital gains, etc.?
So yeah, so so I'll first come to the business or profession, income from business or profession. There are two ways to it. One is obviously that you write books of accounts and actually calculate how much is your profit, loss, whatever. But there has been two deeming options, provisions which have been given, which is 44 AD and 44 ADA, which is for business or profession. So in these, I mean, what I would suggest, I would always recommend to most of the people who are startups, or who don't have a huge business or a huge setup, they could probably take advantage of these provisions. So in 44 AD, which is for business, if you have receipts now till last year, till 22-23, if you had receipts up to 2 crores, now in the current budget, they have extended it to 3 crores. So you could actually go by that presumptive taxation, where you offer only 8% of those receipts as your taxable income. And then there are absolutely no questions asked. So it's always on the presumptive basis. Similarly, for professions, you have to you have to offer 50% as your taxable income. Now, the limit for professional, which is ADA, till last year was 50 lakhs in the current budget. So for 23-24, it has been extended to 75 lakhs. Now, there's of course always a fine print when the government gives these kind of a thing. So in the current budget, when they have extended these or increased this limits, they've also put in a disclaimer that 90% of the receipts have to be online. So technically online meaning on the banking channels. So that's something one must do. But I think that works out best for at least professionals. It definitely works out best. One could, of course, calculate and check. But the other problem is if you have profits which are lesser than these threshold limits, so 8% in case of business and 50% in case of professionals, then one needs to, and if your receipts are above the threshold limits, then you need to go in for tax audit. So there's one more compliance that will have to be made. So it's always best if you can go by the presumptive taxation, because those are no questions asked. You don't need to maintain books of accounts, nothing. You just need to say that, okay, this is my receipts, and this is the 50% in case of professionals or 8% in case of business is my taxable income. No questions asked. So, that's the best way. I think that's something that one should definitely take advantage of. I would always recommend that. The others are, of course, income from other sources or capital gains. Other sources basically are, none of the above. So if the incomes don't fall under salary or house property or business or profession or capital gains, then it comes under other income, which typically is interests, dividends, family pensions, because a lot of them get family pensions. So all those come under the other sources. Capital gains typically are the income where you have any gain that you have earned on sale of capital assets. So it could be immovable properties, or it could also be movable, like shares and securities. So so you have those. There are, of course, for movable property, there are certain provisions. For immovable property, there are different provisions. What one needs to definitely look into it is whether the capital asset is a short-term or a long-term asset, because the short-term capital gain is taxed in your normal income slabs. Okay, but long-term capital gains, of course, have specific this. So from immovable properties, long-term capital gain is taxed at 20%. For shares and securities, it is at 10%. So that's something that one needs to kind of keep a watch on. Because typically in shares and securities also, you have to have only 1 year holding for it to become a long-term capital gain, a long-term asset. And then in that case, if you can hold for 1 year, probably you might be more tax efficient if you think the script is not showing the kind of appreciation that you're showing, or if you feel that they'll continue showing the appreciation. Of course, if you're in a bear market, then one needs to take a call. That's the other stuff that's required.
Possible to set off capital gains of movable against immovable assets, or vice versa, or is it like movable is separate and immovable is separate?
No, it is definitely possible. The only thing is it needs to be the short-term capital gain can be set off only with short-term capital losses, and long-term against long-term. You cannot do a short-term against long-term. So that's there, but whether it's immovable property or shares or that doesn't matter. The head of income needs to remain either short-term or long-term capital gain and loss. That way. Yeah.
And how do we increase the overall efficiency of tax planning when we look at it vis-a-vis the family or our overall portfolio or long-term perspective?
So the best way, so again, when you're doing this, most of the cases, it's a little difficult to do it if one is a salaried person. So I will give my disclaimer that whatever I'm talking here would be always for non-salaried people, because then you have certain flexibilities which one can actually take advantage of, because what we're talking about here is planning and not evasion. So, you need to be in the legal framework and still try to become more efficient, tax efficient. So the best way to do it is as a family first. I think one needs to actually establish how many people are in the family, and how many files can be created, as in, how many taxpayers can be created within the family. And then, of course, you can see how you can spread your income so that you get at least those threshold limits. Everyone gets those threshold limits. So you, if you're on the highest tax bracket, you come to the lower tax bracket and someone else pays. So overall, as a family or as a group that you're talking about, you might become more tax efficient. The best ways here obviously are, if you can get your parents or if you're slightly middle-aged, then even your kids, if they're adults. But what one needs to definitely look into is that whoever you're going to be showing, or because you need to show an expense, and expense in your hands and income in someone else's hands. So in that case, you need to make sure that whatever head you're choosing for expense, the person who is going to be shown as recipient is qualified for that head. So it's like, you cannot call a 18-year-old and give him, a driver's salary, but that person doesn't have a license. That will not work, right? So, you need to be logical when you do it. But yes, I mean, there are ways in which you can do it. The other thing, of course, is gifting. So fortunately, among spouses, there's no gift tax. So what one could also do is, if you have a lump sum where you have a lot of, a huge chunk of interest income that is coming in your books, you could probably, gift something to your spouse or to your children or whatever. So the interest that would then get created would be their income. So it gets off your taxable income and gets into their taxable income. So that's definitely one could think. But again, like I said, for all of this, because there's also you need to make sure that there are no minors, because otherwise it could get their income could get clubbed into your income. There's clubbing of income provisions also. So one needs to be mindful of the clubbing of income, make sure that you don't fall into that, and still and there are avenues. I can definitely tell you there are a lot of avenues which can be looked up, but it has to be a more on a case to case basis, because every unit is unique. So, one needs to actually look at a particular case and then decide what would be the best way. Because I mean, and I wouldn't want to say this, but even family dynamics make a lot of, the thing, the impact in this kind of a planning. So yeah, it has to be on a case to case basis. That's right.
So true. Yeah. When we are looking at overall family planning for the family, there are a lot of things to be considered. When we are looking at an individual also, we have to look at our own tax planning. We not just as an annual exercise, but as a long term. To give an example, I like this example of this PPF versus EPF. Now, as salaried class, we are all entitled to have EPF deduction, that we know. But PPF is available to both salaried and non-salaried class. Now, if a person is a salaried person and they are putting in a lot of, because people generally think it's all the same, and rather you get better rate of interest with EPF. And so I can put here or here, and everything is within the 1.5 lakhs. But you can actually put 1.5 lakhs in EPF, and you are allowed to put 1.5 lakhs in PPF. So if you have the money, it makes sense to put in both. The reason is that after your retirement, when you have another 3 years in which you have to withdraw the entire funds of EPF, but PPF can be kept in the account for life. And every year you can keep withdrawing whatever little amount you want for that year, and that will continue to remain tax-free for your life. So that is a very important difference between the two in terms of tax in the long-term perspective. So
absolutely, definitely. And with PPF, like the lock-in period is 15 years, so it's always advisable that you start early, so that while you are till the time of your retirement, you would be eligible to withdraw from PPF. Exactly. Because after 15 years you can keep renewing it for 5 years every year. Okay, so it obviously it's a very good example, and I mean, I make sure that most of them, at least my clients, make the best of it. But also the other thing, I mean, since you mentioned about those 3 years, the EPF withdrawal, a lot of them don't know about that. So if you already have a parallel PPF which is going on, I always suggest don't withdraw EPF immediately, because till 3 years they'll have to pay interest. And like you rightly said, you get better interest on, most of the time you get better interest on the EPF than the PPF. So I think one needs to also, so tax cannot be, looked at in silo. Because ultimately what you want is, you have to have income which is higher, post-tax. So if you're getting the EPF interest, because EPF interest also is tax-free, but if you're getting it for 3 years at a higher rate, obviously it makes sense to keep it till how much ever you can. So for 3 years, you should utilize that 3 years, which most people don't, I mean, it's I don't know, insecurity or whatever. It's just like, as soon as the full and final is done, they're behind they start the process to withdraw the EPF. So that's another thing that one should keep in mind. Yeah.
I agree with you. I have also seen most people withdraw their PF immediately.
Immediately.
But you can't trust the government. to keep your
Yeah, it's if that fails, then the sovereign fails. So
sovereign guarantee. So it's
yeah, exactly. I mean, then you're looking at a much higher, much bigger problem than your own money.
absolutely.
Yeah.
Last week, we had a session on wills and nomination, but where we had discussed more the practical aspects of it and the legal aspects of it. So this week, we would just like to know in this inheritance portion, what would be the tax impact and how to minimize the impact of taxation on inheritance.
Yeah, so that's a very good question because I believe now, I mean, it was always there, but post-COVID, I think people have realized that the importance of wills and you never know, the life is so uncertain. First of all, inheritance per se is not taxed on the receiver's hand. Okay, that is one thing one needs to remember very well. What people don't understand is inheritance is only that principal amount. Now, if you get something as inherited, so I'll talk about movable property. So if you have FDs or something which has gotten, you inherited, if whatever you interest you earn or whatever you earn off that will get taxed in your hand. So it's not like it's tax-free for life for you. So it's only the initial portion when you get it, you need to, and the other portion, very, very important, is you need to declare that as an exempt income in the year in which you receive it. Because later you might get queries if you've not declared it already. So that's something that one needs to definitely remember. In the year where you actually inherit, show it as an exempt income in your tax returns. Okay, it just will make life easy for you. The other thing is, of course, of properties. Now, again, in property also, what typically happens is whatever gets inherited, obviously there's no cash at that point of time. It's only the ownership which has changed. So the cash would come in or the tax would get triggered only on the sale of that property. So when you're doing that sale, one needs to remember is that the holding period is considered as holding from the previous owner's period. Okay, so that's how you calculate. In terms of planning, what we could also look at is in movable properties, when you actually get cash or anything, you could gift them away to others. So maybe you inherited, but if again, in the family, if you could spread, then at least the subsequent taxes can be kind of spread amongst more than one person. Yeah, that's something that you need to look at. But definitely do declare exempt income in the year you inherit anything. It's really necessary. Yeah.
That is a very important information. I think it is very easy to miss declaring it because you think, okay, it's just come, it's not part of your income. It's very important that people should remember this.
Right.
We just have a query actually. The query is how about retirement planning. So the query that has come is, how do you account for when you are investing for retirement planning? What is the tax implication and how do you get benefits on that?
So basically, a lot of these, so depending on what kind of retirement planning you've done, so at the point of retirement, a lot of things are exempt, like in terms of pensions. So if you have commuted pension, which is the lump sum that you receive, at the first instance, at the time of retirement, if you choose to commute it, and not take it as a monthly. So if you take it as a monthly income, then obviously that gets taxed in the year in which you receive it. But the commuted income up to 1/3 is the limit to which you can commute. That is tax-free in the year you receive it. Again, whenever I'm saying that anything that is tax-free, if it's an income which is coming in your bank accounts, it makes sense that you show it as exempt income in that year. It is very essential, especially now when you have the AISs and all that coming in, because the government is getting a lot of information from banks. So they know that this transaction has happened in your account. So it's best that you declare it saying that, yeah, this is an exempt income. I'm not denying that I've received this money, but it is an exempt income. Okay, so it makes sense. So one is that. The other, for salaried people, of course, it is you have leave encashment, which is again which was exempt till last year. The threshold was 3 lakhs. In the current financial year, with the budget provisions, it has been increased to 25 lakhs. So up to 25 lakhs, if you have received any kind of leave encashment at the time of retirement, that is exempt. So that is there. The other, I mean, most of them would only have the PF, leave encashment, gratuity. Gratuity also paid as per the Gratuity Act. That would be on superannuation, would be exempt. So leave encashment, gratuity, and PF are generally the things that you would get. And pension, like I mentioned, is on commutation, if you commuted it, or if you are going to take an annuity. If you take an annuity, it is taxable in the year you receive it.
Thanks. And we have another query. This is on home loan. We know very well that people pay it through EMI, and EMIs are initially more interest heavy and later more principal heavy. So the question that is being asked is, does it make sense to pay more and start making more payments towards your housing loan, or to reduce your tenure to increase tax efficiency?
Okay, so it depends. It goes on case to case basis. Now, if you have a rental, so the property for which you've taken loan, if you have let it out and you have a rental income, then there is no there's no limit to how much you can claim as the interest. So whatever is the actual interest that you have paid, you get the deduction. Okay, so in that case, it's okay if your interest heavy earlier. But if that property is either self-occupied or have been kept vacant, because then it is deemed to be self-occupied, then you can claim deduction of interest on housing loan only to the extent of 2 lakhs. Okay. Again, only in the old regime. The new regime doesn't have that. Okay. So if you have opted for old regime and you have interest on housing loan up to 2 lakhs, then you could probably, pay earlier and make sure that, it's not let out. Then you try to reduce the interest portion, because you're going to anyways get deduction only up to 2 lakhs. Anything you pay above that is not waste in the sense, you cannot get any tax advantage of that. So yeah. So again, on a case to case basis, what it is going to be. And always, Meera, I mean, having said all this, I always mention that tax should not be the consideration which will drive your core activity. So you cannot you cannot cut your shoe to fit you cannot cut your leg to fit a shoe, right? So tax is only again an enabler, and try to take advantage of it as much as you can, but make sure that that is not the driving force. Your driving force ultimately has to be that how much is the money that I get in hand, right? After tax. So that is something that should basically, I mean, that's my personal opinion, that should drive your planning.
So true. I totally agree with you.
Yeah.
I think we have had a lot of useful information that's been shared today. I'm sure our audience would have been very highly benefited by this. Thank you so much, Vaishali, for spending your time with us. And I would also like to thank the audience for joining our session today. Yeah, there is yet another question. Can we take that other question too, Vaishali?
Yeah, sure, not a problem.
How do you evaluate a CTC package keeping income tax in mind?
This is a very specific thing, so there's no general rules to it. You need to actually sit down, what are the components, check out what the tax liability is going to be, and then find out. There's no general advice here.
It is a very topic, and I don't think it is possible to just give a generalist.
Yeah, you cannot give a general advice here. It needs to be looked on a case-to-case basis. Also, depending on what kind of components are offered in the CTC package, So yeah, it makes a lot of difference. Anyway.
So, are there any other questions, or I think we can? I think any other questions, you all may please put it on the comments, and we'll revert to you, or you can send an email to wiki-career@gmail.com, and we will surely revert to you. Thank you, Vaishali, once again for all the information and the valuable wisdom also, I should say, that you have shared with us today. It was not just information, but more than information. Thank you so much for spending your time with us. And thank you, audience, for joining us. And we hope that you have had you have received valuable insights in our session today. Good day to all of you.